Before you call it a trade, prove it. That demand should make some traders uncomfortable because if we applied it honestly, many of the positions you've taken would immediately lose the right to be called trades. Yes, you entered the market. Yes, you placed a stop loss. Yes, real money was at risk. But none of that proves that a legitimate trade existed. It only proves that you participated. And participation without evidence is not professional trading. It is speculation dressed in technical language. Too many traders have lowered the standard for what qualifies as a real trade. They see price begin to move, locate something that resembles an entry, calculate their risk, and convince themselves they have found an opportunity. Then, after entering, they start searching for reasons the decision might work. Notice the order. They act first, they investigate second. That is completely backward. The evidence should create the trade. The trade should justify the entry. The entry should never be responsible for creating the story. This is why you must learn to separate three things that most traders treat as identical: movement, an entry, a trade. Movement is simply price change in location. Markets move constantly. That movement may be meaningful or it may be noise, reaction, liquidity collection, temporary imbalance, or a failed attempt to change the auction. An entry is simply where you choose to act. It tells us something about your behavior, but it tells us nothing about the quality of the opportunity. A trade is different. A professional grade trade is a completed body of evidence that justifies participation. Within ICC, that evidence has three parts: indication, correction, continuation. The indication makes the initial claim. It tells us that one side of the auction may have gained authority. But a few large candles are not automatically an indication. A legitimate indication should accomplish something. It should displace price, challenge meaningful structure, and demonstrate that the previous auction may no longer be operating under the same conditions. That is evidence, but it is not yet proof. The correction comes next. This is where impatient traders become vulnerable. They see the indication and immediately enter because they are afraid the market will leave without them. They treat the initial statement as though it were the final verdict, but the correction exists to challenge that statement. Can the opposing side reclaim what was lost? Will price reject the new territory? Was the apparent displacement genuine authority or merely temporary aggression? The correction is not an inconvenient delay between you and the trade. It is an essential test of the indication. Without that test, you do not know whether the original move can survive opposition. Then comes continuation. Continuation is where the market proves whether the original indication deserves your trust. Can price resume in the indicated direction? Can it leave the correction with authority? Can it break the meaningful structure created during that correction? Can it gain acceptance beyond the necessary level instead of briefly touching it and immediately failing? Continuation is the lie detector because it forces the market to support its original claim. If it cannot continue, the indication has not been confirmed. That does not automatically mean the market is reversing. It means the evidence required for your trade is incomplete. And incomplete evidence requires one professional response: wait. This is where traders usually object. But if I wait for confirmation, won't I enter late? Late compared to what? Late compared to the trader who guessed correctly? Late compared to the trader who entered before the test and hoped the market would protect the position? Your objective is not to secure the earliest possible entry. Your objective is to participate when the market has earned your risk. An early entry into an unproven idea is not superior execution. It is simply premature exposure. You are not paid for predicting the beginning of every move. You are paid for managing risk around evidence you can clearly define. The need to enter early usually comes from one of three beliefs. First, you believe every meaningful move must include you. It doesn't. Second, You believe missing a move is equivalent to losing money. It isn't. Capital you did not expose to an unproven setup is capital you protected. Third, you believe your analysis should allow you to know what happens next. It cannot. Your analysis should tell you what the market has already demonstrated, what remains unproven, and what must happen before participation becomes justified. That is a much higher professional standard. Imagine a bullish scenario. Price rallies aggressively and damages meaningful bearish structure. That may qualify as the indication. Price then pulls back without completely reclaiming the bullish displacement. That correction tests the original claim. Now buyers must return. They must leave the correction, overcome its meaningful lower high, and demonstrate acceptance in the direction of the original indication. Only then has continuation provided confirmation. The same logic applies to a bearish sequence. Price displaces lower and damages meaningful bullish structure. The market corrects upward, testing whether sellers can maintain control. Then sellers must return, break the meaningful higher low created during the correction, and gain acceptance lower. That is the proof. The entry comes after the trade has become visible, not before. This distinction can completely change your trading. Instead of asking, "Where can I enter?" you begin asking, "What exactly has the market indicated? What meaningful structure was damaged? What is the correction testing? What would invalidate the original claim? Has continuation actually resumed with authority? What evidence is still missing?" Those questions force you to read the market instead of projecting your desires onto it. They also make your decisions auditable. If you take a loss on a fully confirmed ICC setup, you can review the evidence and execution without pretending certainty was possible. A valid trade can lose. Evidence improves the quality of a decision. It does not guarantee an outcome. But if you entered before indication, correction, and continuation were established, the market did not betray you. Your process failed to demand proof. That is the belief replacement I want you to make today. Stop defining a trade by the fact that you entered it. Define a trade by the evidence that justified the entry. Your order does not create legitimacy. Your confidence does not create legitimacy. Your risk to reward calculation does not create legitimacy. The market must create legitimacy through observable proof. Before your next gold trade, pause and make the case. Show yourself the indication. Show yourself the correction. Show yourself the continuation. If one part is missing, the sequence is incomplete. If the sequence is incomplete, the trade does not yet exist. You may see movement. You may see potential. You may even see an entry. But potential is not proof. Before you call it a trade, prove it. Indication makes the claim. Correction challenges it. Continuation delivers the verdict. If it's not ICC, it's not a trade. If you want to learn how to read gold through evidence instead of predictions, join us inside ICCLAB on School. The link is in the description. No proof, no trade.